Shanghai is paying $5 to $8 more per ounce for silver than New York. That is not a rounding error. That is a 7 to 11% premium on the same metal, priced on two different exchanges simultaneously. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, two silver markets are pricing the same metal at materially different levels. The physical market is issuing a verdict. The paper market has not accepted it yet. Let's get straight into it. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now, subscribe to OG John AG 1.0, and share this with one person who needs to see these numbers. Now, back to the data. Lead story today, the Shanghai Gold Exchange physical silver benchmark. The SGE is pricing silver at approximately $78 to $79 per ounce right now. COMEX paper silver in New York is pricing near $73 per ounce. That is a $5 to $8 premium, 7 to 11% above the Western paper price, on the world's largest physical delivery exchange. Gold tells a parallel story. SGE gold fixings are pricing modestly above COMEX's $4,430 level. The divergence has persisted for more than 2 weeks. The timing is what deserves scrutiny, not the gap itself. The timing. The SGE is not a paper exchange. Every single contract settled on the Shanghai Gold Exchange requires delivery of real vaulted metal. There is no cash settle escape hatch, no mechanism to avoid taking physical delivery. That means the SGE price is a direct, unfiltered measure of what real buyers, Chinese solar manufacturers, EV component producers, semiconductor assemblers, industrial firms, are willing to pay for deliverable silver today. When those buyers are paying 7 to 11% above COMEX, consistently, the physical market is making an argument the paper market cannot ignore indefinitely. Think about what that sequence actually means. The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. The last time the physical to paper silver spread exceeded 5% for more than 2 weeks, a delivery event followed within 60 days. The data is already telling you something. Let's build it out. Now let's build the full picture, because the SGE premium does not exist in isolation. COMEX holds approximately 103 million ounces of registered silver, metal that is actually warranted and available for delivery against futures contracts. Against that, total COMEX paper open interest stands at 429 million ounces. That is a 4.2 to 1 ratio of paper claims to deliverable metal. The remaining eligible inventory sits in COMEX vaults but is not warranted for delivery without a conversion process that takes 24 to 48 hours minimum. April 1st notice day is 4 business days away. As of today, 9.1 million ounces remain open in the April contract. The registered pool is already under stress going into that delivery window. That combination, 103 million registered against 429 million open interest, with first notice day approaching and 9.1 million ounces still open, is not a comfortable picture. The rate of registered inventory drawdown is not stabilizing, it is compressing. The data is doing the talking. China's industrial silver demand from solar panel production, EV battery manufacturing, and semiconductor fabrication has been accelerating through 2025 and into 2026. Global mine supply growth has lagged materially. The ones who were told the physical demand story was overstated, they are not saying much right now. And here is what makes that picture even harder to ignore. The gold to silver ratio sits at 66.9 today. Historically, when Asian physical demand for precious metals is structurally this strong, silver outperforms gold. The ratio compresses towards 60 or below. Today it is moving in the opposite direction. Gold has held relatively firm while silver trades at a documented discount to its own physical clearing price in the world's largest consuming nation. At the same time, the DXY dollar index is at 99.66. 10-year U.S. Treasury yields are at 4.35%. Both of these function as real suppression mechanisms on COMEX silver right now. A near $100 raises the effective cost of silver for non-dollar buyers, temporarily reducing demand from European and emerging market allocators. Yields above 4.3% impose a real opportunity cost against non-yielding silver. That is the setup. Before anyone takes that as a green light, these suppression mechanisms are macro-cyclical. They are not structural. They end when the dollar turns or yields retrace. Setups can take a long time to resolve. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Here is the number most people are not talking about. The March 28 ceasefire deadline in the Iran situation. One binary event, this weekend, with asymmetric market implications for silver on both sides. Now the macro variable, because this is no longer a backdrop, it is the primary variable. The DXY at 99.66 is holding silver suppressed, but it is doing so at the lowest dollar level since early 2022. A further dollar decline driven by Iran de-escalation removes oil-driven inflation pressure, and historically, dollar weakness of this magnitude in a pre-delivery COMEX window has preceded significant silver repricing. The current market is pricing a near certainty of ceasefire resolution by March 28th. Look at the DXY at 99.66 and the 10-year at 4.35%, and tell me what probability you put on that assumption holding into Monday's open. If Iran escalates, dollar retakes 101. Oil spikes. Silver liquidation accelerates as risk-off hits COMEX paper. If Iran de-escalates, dollar continues its decline below 99. Oil inflation pressure eases. The Shanghai premium widens further as COMEX drops on geopolitical relief, while SGE physical buyers maintain their bids, potentially triggering the exact delivery demand that forces paper price recovery. When geopolitical binary events resolve, safe haven assets reprice within the first two sessions. Every time a near-term war premium has unwound, gold and silver have moved sharply in both directions within 48 hours. It has not been different yet. COMEX silver Western spot at $73 per ounce. Shanghai Gold Exchange physical benchmark at approximately $78 to $79 per ounce. That is a $5 to $8 documented premium, physical over paper, right now. The short-term picture is genuinely binary. If the dollar holds below 100 and April delivery demand runs hot against 103 million registered ounces, silver reclaims $80 and the gold-silver ratio compresses towards 60. If Iran escalates and the dollar retakes 101, Chinese industrial demand disappoints, and the Shanghai premium narrows through increased imports at lower COMEX prices. Silver retests $65 to $68. That is the only short-term read that matters right now. As for trading around a weekend binary, I cannot see a clean picture on the lower time frames going into Friday's close. I cannot tell you what silver does Monday. Nobody can. If you think you know, good for you. Sidelines into a weekend binary with this much macro uncertainty is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. Dollar retakes 101 on Iran escalation, suppressing non-dollar silver demand and accelerating COMEX paper liquidation. Chinese industrial demand disappoints as economic growth slows, narrowing the SGE premium as silver imports increase at lower price levels. The physical-to-paper divergence resolves by the physical market moving toward COMEX rather than COMEX moving toward Shanghai, sending silver to retest $65 to $68. The bull case is equally real. SGE premium holds above $5 per ounce for a third consecutive week, triggering institutional delivery demand against a 103 million ounce registered pool, 4.2 times smaller than open interest. Dollar breaks below 99 on Iran de-escalation, removing the primary suppression mechanism on non-dollar silver buyers. April 1st notice day delivery pressure compounds against already stressed registered inventories, forcing rapid paper price recovery toward the SGE physical clearing level of $78 to $79. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything I showed you today points to one thing. The structural pressure is already built into the data. The registered inventory at 103 million ounces against 429 million in open interest is a fact. The SGE premium of $5 to $8 is a fact. April 1st notice day in 4 business days is a fact. The only question is when the paper market catches up to what the physical market already knows. Don't take my word for it. Verify every number I gave you today. Check the data yourself. Shanghai Gold Exchange at sge.com.cn. CME Group COMEX silver data at cmegroup.com. DXY and yield data at the Federal Reserve's FRED database at fred.statelouisfed.org. Logic over hype, always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook. Do not wait for the mainstream to catch up. They already know. OG John AG 1.0. Out.